Sanjeev Pattnaik. I'll be taking you across a particular course which has been a part of today's real world, or we can say almost all, knowingly or unknowingly, are exposed to that particular area, that is the markets or the financial markets, or particularly our course is titled as equity markets. So before going into the course, as I said, all of us are exposed to financial markets in some sort of way. We shall try to have the basic knowledge today or in this particular session regarding the course. So our course has been entitled as MMPF 007 Equity Markets. So as we enter into the basic beginning, that is the block 1, Introduction to Financial Markets. So we shall try to understand what that financial system is, what are the segments of that, who are the participants, how it helps people in general in an economy. All these things we shall try to look at. So our particular unit 1 is entitled as Introduction to Financial System. So here we shall look at particularly the Indian financial system, or the financial system that is working in Indian economy. We'll start with what is a system, then we shall look at the financial system in India, its components, its participants. So let us move into our course, the financial system introduction. So while introducing financial system, I would like to say that the nation's financial system is aimed towards the growth and development of the nation as a whole, or the economy of the nation as a whole. So when we are talking of at the present era, we are talking of the trades without barriers, or free trades, or in simple terms we say a particular word, that is globalization. The world has become free to trade by different nations. Even though some nations have barriers, that means the trade barriers, but still most of the nations in the world are exposed to the scenario. That means they have to compete and fight it out with the competition that is arising out of players, whichever geographical nation they belong to. So that brings in the robustness, and it instills a quality to improve day by day the products or the services that they are producing, so that they remain competitive ahead of the competition and also meet the global challenges. So when we are talking of globalization, we say nation's economic structure should be such that it should be in line with or aligned with the developed economies. When we say developed economies, we mean the Western countries like the United States, the European nations like Germany, England, France, etc. And also we also take into account Japan also. And India is also moving towards becoming one of the nations to be called as developed economy. The government is putting a priority of how quickly that can be achieved. A roadmap has been done, so they are looking at the alignment of Indian economy with the developed economies. When you are talking of financial system, what is a system? Uh, Let me give an example. When we talk about, suppose, educational system, the educational system will consist of schools, colleges, universities, uh, organizations focus on research or academic excellence in research, etc. Apart from that, it will also include faculties, the students, the infrastructure, the various types of, we can say, developmental laboratories, etc. Now, what is the purpose of bringing all these things together? The purpose is, or the goal is, that a student attains the qualification levels up to whatever stage he or she is learning. So when we are talking of educational system, it has a purpose, and the purpose is achieved by a combination of various kind of components like the students, faculties, the amenities, infrastructure, regulations, etc. So simply speaking, we can call a system as a collection of components that interact with each other to achieve a goal. Our topic of discussion today is the financial system. So now once we have understood what is the system, we can now have a fair idea what we mean by financial system. Look around us. What things uh, deal with finance? We can say banks, we can say business houses, we can say business establishment, we can say the various service providing companies, etc., etc. Along with that, we also have the exchange or the mode of exchange, that is the Indian rupees through which we can buy the goods, or we can have digital payments, the digital platform. We can also invest in banks fixed deposits, in companies securities, etc. As we move on, we will be looking at it. So when we are talking of financial system, it is the collection of financial institutions in the economy, the markets, the instruments, and services also. What is the goal here? Think about us. Suppose a person is a service holder. He earns an income, suppose 10,000 rupees per month. He finds his average monthly expenditures are rupees 7,000. He earns 10,000 rupees but spends 7,000 rupees for his own consumption or own requirements. He or she still has rupees 3,000 left after meeting all kind of requirements. So what we shall do with those 3,000 rupees? There are two possible ways. Either we shall keep it with ourselves or we shall give it to somebody else. Now, who is that somebody else? That somebody else, maybe a bank, maybe a financial institute like a mutual fund, or you can say procurement of fixed assets like land, building, etc. So the goal of financial system is to facilitate this transfer of excess or the surplus amount in the hands of common people in an efficient and effective manner to a certain intermediary who then again will allocate and utilize these resources in a proper manner. Now think of a bank. I am giving my surplus money since I am a service holder, the 3000 rupees surplus I am having. When I give it to the bank, similarly other people will also be making deposits with the banks. Now, this 3000 rupees or somebody else is contributing 5000 per month, somebody else may be putting in 40,000 rupees, etc. etc. So, bank will be building up deposits. Now, what it will do with deposits? It will try to allocate it to various the deficit organizations or persons. Now, deficit organization, when we say, suppose a organization is requiring to set up a plant, manufacturing plant. It requires huge amount of money. It may not be possible by the organization to have that kind of money in their hands. So what they can do? They will approach the bank or the financial intermediary that you please provide us some money in certain forms. So banks which has collected the surplus amounts or the financial institutes who have gathered the surplus amount from the people like us who have surplus income, they will try to allocate the resources to the needy sector or the deficit sector so that it gets properly utilized. So this is the introduction to our financial system. Now let us look at the financial system and its components. What does the financial system do? Basically, we say through various components, it provides the foundation for growth and development of the nation's economy. It tries to improve the economy day by day so that the economy goes towards being a developed economy or a robust economy. Now, what are the components? When we are talking of components, basically we can categorize them into the four components: financial markets, institutions, the instruments and assets, and financial services. Now, financial markets. What is a marketplace? A place or any designated area or any area where both the intending buyer and seller for a certain either product or service come together. So the funds get exchanged from the buyer to the seller. That means it is channelized from the buyer to the seller. Buyer takes either the product or the services and in return pays to the seller the money. the funds. So we say financial market help in channelizing the funds. Then comes the second component or another important component, that are financial institutions. Now, who are the institutions? Just like we said, schools, colleges, universities, etc., in an educational system. Now, here, who are the institutions? We can say the government agencies, the corporate houses or the corporates, various banks, financial institutions, householders, and general public, etc. Government, it always has an objective that how the roadmap for becoming an developed nation can be created. So they try to bring upon the various types of regulations, various types of subsidies, various types of we can say primary objectives in the budgets through taxes, etc. Corporates, they require funds, so they try to gather funds through various kind of financial instruments. Banks, they are one of the most important intermediaries of channelizing funds in the Indian economy. Mostly Indians try to put their surplus income with the banks, and banks in turn try to utilize them judiciously by investing or putting those money in different required sectors. Financial institutions like mutual funds, etc., they also mop up funds from the general public so that those funds are diverted towards our required sectors. And general public usually are the savers in the nation. We say na, small drops of water forms the ocean. So general public, they contribute little funds either to banks, the financial institutions or the corporates or the governments, and a whole body of funds that looks like ocean of funds is created, which can be utilized for the required sectors. Another important component are the instruments and the assets. Now, what are the instruments and assets through which usually the above financial institutions channelize funds? Banks, all of us know that we have fixed deposits. Everyone mind, when we talk of banks, if we have surplus money, we think of let us put it in a fixed deposit for a certain period of time. Apart from that, bank also give you the SIP, systematic investment plans, the savings account, etc. etc. So those are all the instruments through which you can channelize your funds through banks to the needy sector. Corporates, they usually go for financial assets or securities, we can say, like equities and debt instruments like bonds, debentures, etc. And the fourth component is the financial services. It is not always that everyone knows about the tits and bits of finance, how the money is growing, which sector will be having a better growth prospect, which sector is less risky. This idea is very difficult for all the general public to know unless and until we go through certain kind of education. So we have financial services like the advisory services, like broking agencies, like the tutorial groups given by various organizations like SEBI, etc. So all these components, they combine together and frame the financial system of Indian economy. Now let us see in detail the components. First, let us look at financial markets. So here we are having two things, finance and the markets. So as I have said, market is any place, not only designated place, but any place where buyers and sellers meet to exchange goods or services for a consideration. That means the funds. Buyers pay the money and take the goods and services. Sellers take the money and give away the goods and services. So that is the market. Now, suppose earlier we required certain things. Suppose a computer, let us see. We are having class now. Let us go for a computer, purchasing a computer for our home. What we have to do? We have to go to a particular designated marketplace where computer items are being sold. There we look at the choices available, then we purchase it if it satisfies our requirement. But nowadays what is happening? All of us are having smartphones or the AI technology. Using the smartphones, we can sit at the convenience of our house or home and we can see the product catalog of computer manufacturers or the computer producers or the desktop producers, and we can select the various requirement in our computer and get the assembly done. And the computer producer or the desktop producer, they will deliver the good according to our requirements at our doorstep. How this is possible? Through electronic marketplace. So at our fingertips or in the palm of our hand, we have the market, whole market, anything you require. You will be having platforms, or to say in simple words, various we can say websites which assist you in procuring the goods. You select the item, either you pay upfront or you try to pay it at the time of delivery, and the company or the product that you have selected will be delivered at your doorstep. So now we are having a electronic marketplace for anything that you are requiring. When we are talking of markets, We categorize them into three: product, factor, and financial. Product market, goods and services. Goods are those items which can be touched, which can be felt, they can be measured in exact terms, etc. But services, they are the qualitative things. That means it talks about how you feel. Suppose medical services, suppose teaching services. You can feel it, but you cannot touch it. It is very difficult to measure them. So when you are talking of product market, you are talking of two things: goods and services. Looking at the operations, in earlier days the term was production, which was meant for converting a given set of inputs into a desired output in the form of products. So when you are talking outputs in form of products, that becomes goods. So nowadays, instead of production, we are using a term called as operations. That means from a given set of inputs, we try to uh, produce outputs in form of either the products or services also, like medical services, teaching services, recreational services, etc. So we say the basic factors for operations are the land, labor, and capital. Land, the place you are talking of, either to set up the factory or where to provide the services. Labor, labor can be divided again into skilled, unskilled. Skilled are the person who will be dealing with all kind of high technologies or latest technologies, etc. Unskilled, they will be dealing with only the physical, we can say, labor or physical work. And for having all these things, we require funds. That means the capital is required. So the factors also have markets. Land, where will it be available? Labor, where we can have the labor. Suppose let us consider a software company. Anyone who wants to set up a software company, a big software company, they think of, suppose Bangalore, suppose in Bangalore they will set up the software company. Why? Because availability of labor is plenty there, and marketplace or the land is available for those kind of activities. So arrange the capital, have the software firm established at your designated place. The fourth component is the financial market. Now, what are financial market? Now, those deal with the financial assets. So, when we are talking of financial assets, we are talking of securities, either in form of equities or in the form of debt instruments. So what are these instruments? Now they are nothing but the financial claims on the company or on the organization who have taken funds from us. Uh, think about a fixed deposit with a bank of rupees 1 lakh. You have made a fixed deposit 1 lakh rupees for 3 years. Now at the end of 3 years, you will get back the amount along with the interest. Suppose it is 3 lakh 70,000. You have the right or the claim over 3 lakh 70,000 from the bank. Bank is bound to give you back the amount. Suppose you say my claim is not 3 lakh 70,000, it is 6 lakh 50,000 something. No, it cannot happen. How much is your amount, deserving amount or the claim, that much you can get from a financial market. Be it financial institutions, be it banks, be it corporates or stock exchanges. Second thing about financial market is the price discovery. Uh, think about a bank loan. Nowadays, when we purchase vehicles, etc., we go for bank loans. And interestingly, you will find the rate of interest that is being charged on the loan amount will differ from bank to bank. So according to your requirement, you choose the best interest rate. That is, when you are saying best interest rate, you are discovering a price for your loan. Similarly, think about a equity share. You can only claim the ownership of a equity amount paid to the company whenever liquidation is going on. If any amount is left after paying to the debt holders, that will be distributed among the equity shareholders. And maximum distribution can be up to the number of shares that you are holding or I am holding. So here you can say our claim is limited. But think about trading of equity in a stock exchange. In stock exchange, many buyers would have come along with sellers for that particular company's shares, or they will be interacting online. So whatever price you are quoting, somebody else may quote a either higher price or lower price. Similarly, the buyer would be looking at what will be the lowest price for the securities that he has intended to purchase. So out of various quotes given by various people trying to sell that particular company equity shares, whichever is the lowest one, we shall be choosing that. So what is happening? We are discovering the perfect price for that particular security, and we call it as the price discovery. Now when you are talking of financial markets in Indian economy or in any economy, what are the various components of financial markets? First is money market. Look at the name, money. So this represent the financial assets which are close substitutes for money. We say money is the most liquid form of financial asset. Any item or any asset which can be converted into cash as quickly as possible, we say them as more and more liquid or in liquid form. So, those instruments or the assets which are close substitutes for money, they are traded in this particular money market. And how do we bifurcate it from the uh, stock exchanges, etc.? Now, simply by putting a time period barrier for the thing. Any financial asset having a maturity less than 1 year or maximum up to 1 year, then we call them as the money market instruments. Anything having a duration or a life period of more than 1 year will be taken in the exchange, stock exchanges. Now, who are the participants in money market? Now, mostly in earlier days, it was RBI, Reserve Bank of India. But today, many have come forward to participate in the money market because the amount of interest they get is very compensatory for small amount of time they are parting with their money. So the participants are RBI, that is Reserve Bank of India. Second is DFHI, Discount and Finance House of India. Mutual funds, banks, corporate investors, non-banking financial corporations, state governments, provident funds, public sector units or the government manufacturing units, etc. They take part actively in the money market because when they have surplus money, their requirement of money is always there. But there are certain period of times when they are left with surplus funds in their hands. If they can utilize that by investing them in the money market, they may get some returns out of that. Now, what is the function of money market? Now, it is the equilibrium between demand and supply of short-term funds. When we are saying short-term, the time period is usually less than or equal to maximum 1 year. So whatever are the short-term funds that are left over with a participant, they can invest that in the money market. Sometimes RBI or the central bank intervenes for liquidity. Liquidity means how much cash is floated in the economy. We have interest rates as prescribed by RBI in the Indian economy. What happens? The commercial banks, they will try to see at what interest rate RBI is providing them funds. they try to enhance that so as to cover their expenses and have some profits, and they provide loans to the customers or any kind of fixed deposit. They try to give at least the minimum rate provided by Reserve Bank of India. Now, suppose the today's interest rate, short-term interest rate in the open market or in Indian economy is 5% per annum as per RBI regulations. RBI wants to infuse liquidity into the economy. That means it wants to flush the bank with funds so that banks will not feel hesitant to give loans to the needy people with proper documentation. Earlier, due to constraint of funds liquidity in the economy, banks were very tight or rigid in providing loans. Not everyone could get it that easily, as it is happening nowadays. So here we can say, let RBI reduce the interest rate a little bit. That means to suppose 4%. So when the bank requires fund or banks are taking funds from RBI, they have to pay less rate of interest. So that will induce them to have more amount of fund gathered from RBI. And they in turn will try to provide loans to the needy sector. Suppose the economy, Indian economy faces a situation of inflation. Inflation means we have too much cash in the economy, but goods and services do not increase in that proportion or remain stable as it was before. We have more cash, so people will be ready to pay higher amount for the goods and services which are not sufficient to meet the overall requirement. So this leads to an increase in the price of goods and services. So in order to avoid this kind of inflationary or inflated conditions, RBI sometimes also increases the interest rate at which the commercial banks can take funds from RBI. In other words, when the commercial banks are taking at a higher rate of interest from RBI, then they will also try to offer loans at a higher rate, and that makes the needy sector hesitant to take loans, because higher the interest rate of loans, the difficult it is to pay back the money, because higher and higher amount you have to pay back. Another feature or function is easy access for users and suppliers of short-term funds. Nowadays, due to electronic platforms, anyone can participate easily in the money markets. And whenever there are surplus short-term funds, what is the price or the rate of interest at which that is mopped up by the needy sector is also done by the efficient market clearing price by the money market. Now we come to the market which deals with any kind of instruments or assets or securities which are having a maturity of more than 1 year period. That means they will retire after maybe 1 year, maybe 2 year, 3 year like this, but not less than 1 year. So the major assets in this capital markets are the equity and the debt assets. Now, when I am talking of equity, we are talking of equity shares. When we are talking of debt, debt assets can be the bonds or the debentures, etc. Now, who are the participants in the capital market? The individuals, the banks, corporate entities, they all participate in the capital market. When we are talking of what is the purpose of capital market in Indian economy, let us look at the functioning or the functions of capital market. Now, capital market is a platform or a place where financial assets of less than 1 year or more than 1 year are traded between buyers and sellers. This has been categorized the capital market, which is a market for assets having a maturity or duration of more than 1 year, into primary market and secondary market. Now, what is primary and what is secondary market? Suppose we are establishing a new company. It requires 500 crores of rupees. Earlier, I had set up two other companies which got into business very nicely and they are running profitably. So now I am thinking about setting up a new factory, a new product I will be producing. For that, when I require funds, that kind of funds may not be there with me, or all the funds may not be provided by banks. So what I will do? I'll try to go for funds through financial assets like equity shares. So I will sell the equity shares for the intended company through IPOs, initial public offerings. So when either new company or existing company raises fund from the market through a new issue or for the first time, the security will be floated in the market. Then we call it as the primary market. Now, all right, a company has sold through IPOs various securities. I have purchased or I have got 500 of those securities with an investment value of 50,000. So that means 100 rupees per share. Now, after 3-4 years, suppose I require the money for a certain financial emergency in my family. What I will do? I will try to sell the security in the marketplace. First time the company has sold the equity shares through IPOs to various general public or institutions, out of which I am also a part. So first time. Second time is what? When I need money after it is being floated and after 2 3 years, I try to sell those securities so that whatever is the liquid amount I am getting, that will satisfy my emerging needs. Now, what is that place? Nothing but we say stock exchanges. In earlier days, stock exchange was a designated place, physical place, but now you can find electronic platforms of stock exchanges on various desktops, websites, the mobile phones through internet connection. You can access the stock exchanges. So stock exchange try to provide liquidity for these financial assets. So capital markets are divided into primary market, that means first time market, and secondary market. Now, people when they are going for IPOs, they look for the promoters, that means those who are floating the company. What is their track record? Were they successful in the past? Does their company has an idea of producing certain item which will satisfy a future need? That means a startup company. Now, when I am selling for my securities that I have got through IPOs for the second time, uh, I will go to the market. When I am selling it, always I will require the highest price for my securities. Now, if my company is having a very good track record regarding the financial operations or the operations in general or the future, then immediately people will be ready to buy it at a price higher than the expected price. So that way we can know which sector is requiring more funds or funds to be efficiently used. So it improves the efficiency of capital allocation. As I said, competitive pricing mechanism, buyers and sellers they try to buy for either purchasing at the lowest price or selling at the highest price. The equilibrium reached will be the price discovered or the agreed price or the market price, and this also helps to increase the ownership base of the company. Anyone having equity share can become a owner of a company, and the cost of capital is low also. Another important financial market is the forex market, or in simple terms, foreign exchange market. Think of a situation. Many Indians are nowadays traveling to other nations either for vacations or for office work or for meeting their relatives, etc. Suppose you are going to a country like uh, Great Britain or England. What you will do? Shall we take Indian rupees along with us, or our Indian rupees in our bank accounts be valid in England? The answer is no. You have to change it into currencies of England, that is pounds. So when we are talking of foreign exchange, we are talking of the currency of a country other than the home country. Suppose we are Indians, our home country currency is rupees, Indian rupees. Any other country's currency becomes a foreign currency to us. Now, if you look at the equilibrium between pounds and rupees, a pound may be around 100 rupees, or in other words, if I pay 100 rupees, I will be getting 1 British pound. So I can write or say 1 pound is equal to 100 rupees. So it gives a equilibrium of how much rupees I have to pay to get a foreign currency. That is called as foreign exchange rate. So whenever you travel outside or have to make payments to outside countries, you have to look for forex currencies. Now through foreign exchange, what happens? Funds from one nation to another nation happens. Suppose we are making a payment to a company in US, we will be paying them in US dollars. Or a US company, if they are paying to Indian company, we may require the funds in terms of Indian rupees. Who are the participants? Now the individuals, non-financial organizations, banks, official bodies, private organization. We can also include here we, because nowadays more and more Indians are traveling to outside world, that means out of the Indian geographical region for travel and leisure, for which they require foreign exchanges. And this whole foreign exchange market is regulated by RBI, Reserve Bank of India. Similarly, we also have commodity markets. When we say commodity, it can either be gold, silver, precious metals, energy products, agricultural commodities like wheat, maize, bajra, etc. So when you are exchanging commodities from one country to another, the funds also shift from one nation to another nation. So here also exchange rate comes into the play. It is regulated by RBI. Now let us look at another important component, that is financial institutions and intermediaries. Those are Reserve Bank of India, commercial banks, stock exchanges, Securities and Exchange Board of India, that is SEBI as all of us know it. We also have depositories. Who are the depositories? Now those who keep safely and securely our holdings of securities in electronic format. So in India we have two institutes, NSDL, National Securities Depositories Limited, and Central Depository Services Limited, CDSL. And when transactions take place, usually a clearing house takes charge of that, and in India it is National NSCCL. When you are talking of instruments and assets, we talk of securities, derivatives, the foreign exchanges also. So, all these instruments and assets we will be looking at in our course as we move on. Apart from that, in the Indian economy, we have financial services. Look at fee-based services. We have advisory services, credit rating, mutual fund services, issue management. That means when a company issues IPOs, etc., it gives the task to another organization which does the work for them for a fee. Another is fund-based services like leasing and hire purchase. We require a car, we go for a car loan. For that, some charges we have to pay. We require housing finance, a loan for house, then we go for housing finance. For that also we pay some charges. Use of credit cards, immediately funds are provided by banks and we get the thing. So looking at all these things, as we move on, we shall be discussing more and more regarding the equity market. With this, we try to end our session today. Thank you.